Hey, Devin, it's really nice to have you on Fractional and Focus. I'm Max Weisbrod, founder of Baton and host of this podcast. Devin, could you tell us a little bit about yourself?
Yes. Thanks for having me on, Max. My name's Devin O'Brien. I started a company called Kordis, which is an outsourced fractional CFO and accounting partner for startups and SMBs. So we work with companies pre-revenue all the way up to, SMBs doing $40 to $50 million in revenue and really serve as their either outsourced finance function doing, CFO, FP&A accounting, or for some smaller business, we really just run their accounting side.
So, what problem did you see that you're filling with Kordis?
Yeah, so I think the main problem was, really founded upon seeing people, startups that, they're have their domain of expertise. They're building something great. They have this vision, and finance tended to be the kind of, lack of a better term, redheaded stepchild. No one's really paying attention, right? And when it comes to going through a capital raise or an M&A transaction, right, most, qualified investors are going to actually want to see, financials that are, tying out, reconciling a financial model that shows how it can scale. And, there was no one really dedicated to that side of these businesses. And so coming from, investment banking and seeing, private equity firms and the level of diligence that it takes and time it takes that they'll be picking at everything to get, funding or to get a deal done, I noticed that wasn't set up in really SMBs or startups. So my goal was really to come in, whether, you want to do an M&A transaction or raise, but, I always call it like a built to sell level of detail, right? Like we're trying to get your accounting and finance to the level of detail where if you ever did want to go to sell or go through a raise, everything is buttoned up. We can ship things over to the other side. And, it's a very quick financial due diligence process because, we made sure that everything from, the get-go as buttoned up as it could be. And we can tell the financial story that you're looking to tell.
And you are a fractional CFO.
Yep.
And it sounds like you also work with fractional CFOs.
Yep.
How do you see fractional CFOs fitting into your ecosystem?
Yeah. So what we do is we kind of have a suite of accounting and finance people under us. So there's myself, and then there's 3 other CFOs. And so we kind of use our own software and kind of our own accounting team to bring on other CFOs with us as well, who maybe don't, they're scaling right now by themselves and they need an accounting person, or they need access to, VAs or admins, or they need access to a financial forecasting software, or just advice where they can talk to other CFOs. So our model is, we have some of the core people who founded it being CFOs, but we're also, rolling up other CFOs that want access to a broader based team with more knowledge or more resources to help them scale their businesses as well under us.
And how are those fractional CFOs currently providing this, for their clients? Like how are they solving it without your software?
Yeah, I think there's a lot of different softwares in the space, but everyone does things differently, right? It really depends on the client and what they're looking for and kind of their past experiences. Some clients are like, hey, I'm a former finance guy, or I worked in audit, or I did X, Y, and Z, and I want to share versions of Excel back and forth, or I want to use Google Sheets. So, those, core products still exist for, a lot of financial information and a lot of people because that's what they're used to. But a lot of the people that we work with want to see charts and graphs. They want things automated. They want, logins to be able to just not have to ask you to share the most recent version of the model. So I think without us and, our software, people are still using the, bread and butter of Google Sheets and Excel. And then there's some other softwares out there like LiveFlow and Pry that I think other people are leveraging as well.
So when we start talking about like your fractional practice and, what that looks like, can you tell me a little bit more about like how you broke into the space and how you got your first customers?
Yeah. So first customers, I didn't really know the space existed or there was a need. I was working in healthcare investment banking, and I had a friend who was the COO of a few startups, and I'd helped him here and there for various payback periods or things he would need just to kind of help him out or review his financial models if there wasn't a finance person, at his startup, which there rarely was. And then towards the end of 2021, he joined a new startup and they were about to go through a raise. And so I kind of helped them clean up, thousands of transactions in QuickBooks, get the house in order, build a financial model to tell their story. And from that, my whole, value prop has been in this space is, we try and over deliver. We're not charging hourly. And so, I built a really good relationship with them and, the founder. And from there, they asked me, to stay on and make sure the books were clean and help them answer questions. And from there, it kind of scaled to when I wanted to go full time. I didn't do any marketing or anything. I just asked them if they knew anybody else who needed people, in the similar role. And very quickly, there was 2, 3, 4 word of mouths that, were looking for it. And then still to this day, we almost exclusively work either people from Twitter that, come inbound, or just straight word of mouth. So no cold emails, nothing really else. It's we're trying to be selective and really only work with people who we feel like we can provide the best value for.
So talking about only working with people you're able to provide the most value for, I mean, I've seen this. I turn away a lot of people who aren't good fits and I wouldn't be able to provide value and I don't think are ready for, product engineering type work. What does a bad fit look like when you're talking about an early stage fractional CFO?
Yeah, it mainly comes down to what you're looking to do, right? What is the person who's contacting us? What is their end outcome? So if it's, something very, very quickly that they just want to get a quick financial model and just kind of ship it out and leverage it, for us, that's difficult because it takes a little while to understand the business, right? I want to understand, over time, the model, how you're doing things, how things are scaling. So a lot of it is what is your, what is the outcome? Are you looking for a partner or are you looking for a quick transactional thing? Because we're really looking to partner with people. So that's kind of one of them. I'd say the other one is, similar to the outcome is, we'll talk to people who say, hey, I want to raise. And, we go through and we see what they're trying to do. And, depending on the unit economics, the business, where they are, it's sometimes, just from my past experience in M&A, I'm saying, hey, that valuation is probably a little bit of a stretch. I don't know if I can get you there. And, or I don't know if I can get you there in the time you need, right? It takes time. I need to learn a little bit about the business. And if you need something because it's, a distressed or a dire situation to try to, really make sure you get this capital, ideally, we're not doing that because, we want to make sure that it's not, we're trying to get the end outcome. If we don't feel like we're the best person to get that end outcome in the time needed, then, we'll just pass on the opportunity.
Which are, honestly, both fantastic cases, right? In the second scenario, we talked about how much is it worth to get that kind of reality check, right? Yeah, that could save people months of time. In the first case, I remember, my last startup job, I came in and I looked at our accounting partner and the chart of accounts had nothing to do with the business model. I noticed that when people go to these big monolithic, accounting firms I'm not going to name any, but that serve the startup space, a lot of times they're just taking, just some standard model chart of accounts that has nothing to do with their unit economics or how things break down, and then just layering it on. And then, you wonder why you don't know anything about how your business is running.
It's spot on. When we come in, typically, right, we will go in and we'll say, hey, can we get an NDA and look at kind of under the hood? Because that's going to determine, how much work goes into the front end. And it's typically a lot of back and forth, right? What is this vendor or, how does this happen? But yeah, it's very common where we'll come in, working with a fitness business and they have, personal training revenues, but, none of the actual costs associated with those, personal trainers will be in a direct labor cost of revenues, right? Everything is booked down in OpEx, or sometimes they'll put rent up in COGS. And it's well, no, we're trying to show gross margin as it truly is. So exactly like you said, right? It's you can see right away, do they really understand the business and finance? Because, either they're throwing a bunch of things into COGS or cost of revenues that shouldn't be there, or they're throwing nothing in and that's just not really accurate, right?
Getting 80-90% margins when they're actually entirely, 50% of the revenues out the door to a contractor from day one.
Yeah, exactly.
Okay, so for the clients that you are taking on, like what are the transformations that they're looking for? Like why are they coming to a fractional CFO?
Yeah, I think, I think there's kind of two main cases, right? I think, one of them is on the smaller side. So if we work with someone who, has a, like a content agency, or like, we work with someone who creates content on YouTube and has affiliate income. For them, it's really breaking out the business segments, right? They have different business segments or different unit economics for their segments. And so a lot of times what we'll see is, hey, you have like really 3 core businesses in one, and you're booking it all kind of consolidated in your books, right? So it's hard to tell you should double down on this or this one's losing money because it's all just aggregated and you don't really know. So, on that smaller end, it's let's segment this out, show the unit economics on a P&L, by class in QuickBooks where you can see the different segments. So I can say, hey, like there was this massive expense for this in this segment. Why? Like, is that going to stay? Or, hey, we're spending too much money on marketing in this segment and it's not actually hitting the top line and driving revenue. Let's adjust that. So for them, it's more of like KPIs and analysis and making sure that they're strategically running their business and their different segments and focusing their time and efforts. On the startup side, it's usually around fundraising and kind of analysis and scenarios, right? So if we do this, if we lose this, what happens? When do we run out of cash? When will we break even? When do we need to raise again? So on the startup side, a lot of times, we have a financial model that helps tell the story of the unit economics and where it goes. And that's really to help with the fundraising side. But we also have like a more bearish, what I would call like a cash burn model, where we're really just looking at, what is happening on, a really bear case and making sure that they don't run out of cash in the next 2-3 months and making sure they're ahead of it.
Don't pull a fast.
Yeah, exactly. Right. Very quickly and managing burn too. Right. So it's like, hey, you're burning a lot or this is non-recurring and we need to understand like the whys. So if we show them, these various scenarios and then it comes in way higher, we can double click in our software into like, well, we budgeted by line item in QuickBooks. Here's the biggest variances. Why was that? Right. And sometimes it's cash basis, 3 payrolls hit. Okay. Like that's fine. Or it's, wait a second, like our legal fees were $85,000. Like what happened there? Right. So it's things that they just don't know kind of from the day to day that then we can pull up and say, hey, this happened. Like, what are we doing to change this? Or how, is this part of the go forward business? Do we need to raise? Do we need to change something? Do we need to cut here and there?
So when you're coming into these early stage companies, where are you seeing them going off track?
Most of what we see in these early stage companies is going off track is really just not really understanding like where things are being spent, right? Like where are the biggest allocators or where are the biggest cut opportunities? So what I always say is, a lot of people come in and they think, hey, you're our CFO, right? You're going to come in and, within a couple of weeks, you can tell me like, we're paying too much for this or this or this. It almost doesn't really ever work like that, right? We don't know the people. We don't know the business model. The first couple of weeks we spend getting to know the business, getting to know the people, getting the house of the financials in order. And then from there, we can say, we'll start asking questions like, hey, like we just noticed that we're spending on this Google ads. And when we ask the contractor who runs them, like the password to, see what's going on there, they say, oh, that the previous person set that up. I don't even know what the credentials are. And we're like, well, who's reporting to that person? Like, well, who's holding them accountable, right? So it's like, from there, it's a lot of, we almost kind of come in, and when we start to understand the business model, we start to make recommendations of like, these 2 people do the same things and we're paying both of them. We're like, this person does like this little thing for this business. They make a lot of money, but it doesn't generate a lot of revenue. So we're really just like trying to understand and help them on like, where is the spend going and is it actually driving outcomes that we want, either operationally or revenue?
It is really interesting to see, like, you've got 2 peer companies, and a lot of the things that are different between them are, very idiosyncratic, right? Because, like small differences in how they segment the market and where they go can mean like really large changes in terms of like the OpEx profile of that company. But in a lot of these early stage companies, you do start going through like an audit process and you do start interviewing people. And you do find that like there are, these big problems in terms of how like the management culture is evolving, and how they're burning resources. So when we're thinking about that, do you see like a particular like profile of management team that is like least susceptible to this, or one that's like most susceptible to this pattern?
Yeah, I mean, I think it's typically most, right? And I think what happens with a lot of the people that kind of we've worked with is they're visionaries, and they built this. This is kind of their baby, and they're so focused on growth and those things. And a lot of times they've brought on, especially in the early stages, people who were friends or people who they knew, friend of a friend, right? And they kind of wanted them to mold into a role. And over time, right, as you're trying to grow or you're trying to get, you got a higher valuation a while ago, and now you're really trying to get to there, I have to ask that uncomfortable question of, is that person still the right fit, right? Like, is that person driving what we want? Like, we want to get this outcome. Can they do that? And a lot of times we'll have, C-suite conversations where they'll say, oh yeah, like so-and-so, like reached out to them, didn't really even answer my emails about this new partnership. I had to go close it. And you have to almost be the guy who, because you're the outsider, you don't, you're not in the weeds and you don't have those kind of same feelings. You're not like, you can be that guy who has to uncomfortably say like, okay, can they still get the job done? Do we need to find somebody else? So I think it's a lot of just visionaries focused on growth. And, early on they had friends or had friend of friends who they could pay, what they could afford, and wanted them to mold into this role. But as they got more funding or as they grew, they can't, these people necessarily can't deliver, and they're not like micromanaging them. And you have to just ask those ask those questions of like, I think there's probably somebody more qualified, that's a little more expensive, but could 4X the outcome. Do we want to look into that?
And I talk to a lot of founders, and one pushback I'll hear on the concept of having fractional executives is they don't have skin in the game because of the retainer model and all of that. But from what you're saying, it sounds like, really what ends up happening is that because they're not enmeshed in a lot of those, corporate politics and internal, like way that things are, it ends up being more of like a reality check.
Yeah, 100%. And and that's a really good point is, if you're, not aligned, we really try to make it feel like, as I was saying earlier, we try to be a partner and where we really can add value, and we want to build a relationship, right? Because if you don't have that relationship, you can't say those things because you're always worried about, oh, I'm on retainer, I'm fractional, I'll just get canned, right? So it's like, you have to build a relationship because you want them to feel like you are an equity owner, you are part of their core team, and your goals are aligned with their goals, whether you have equity or not.
So as we're looking at like the next couple of quarters, what trends are you seeing? What are you thinking about for your business and for your fractional practice?
Yeah, I think, for us, I think that what, in the startup space, it really, as people talk about when, interest rates aren't zero, the access to capital is a lot less. So I think for us, a lot of the trends is around really just helping people to understand where they can cut and getting, a manage on their burn, because fundraising may be at a down round. So I think a lot of our conversations are around spend right now and are around, bear cases and making sure that there is sufficient funds to do X, Y, and Z. And I think that will continue for a while because, the frothy valuations and, free money are just not flying around the way they used to. I also think, on the SMB side for us, the conversations a lot are trending towards M&A transactions. People who've been running these businesses for a long time that have gotten dividends, et cetera, out of them, blue collar businesses that just don't really want to handle it anymore. And I know people talk about it. You see threads on Twitter about it. A lot of these businesses, are going to transition into somebody else's hands or close. So I think a lot of the SMB side for our focus is getting people prepared to sell or getting them in a position and then helping them to sell and finding someone new to take over this business and kind of changing the ownership, changing the capital structure on the SMB side. And then really just, as I said, on the startup side, it's really focusing on honing in spend as much as possible and being lean to try to survive until, something maybe changes with capital or interest rates.
And what we're seeing like another set of M&A happening where enterprise customers of some of these SMBs and companies are trying to, clean up their P&L. They're trying to, find contracts that maybe aren't as profitable as they could be. And they're pushing for basically, I wouldn't say hostile, but they're pushing for acquisitions in order to, consolidate that and get that margin.
Yeah, I think a lot of, we've had conversations even just this past week of, startups that have traction and they don't necessarily know if they have market fit, right? They have substantial revenue, but they have substantial churn. And they'll say to us, should we raise or should we try and do an M&A transaction? And kind of from my past experiences, buyers don't really like when you don't know exactly like what you want to do, right? If you tell people, well, we might raise, we might do this, it's kind of like a lack of focus. And some of them don't do minority investments and raises. So they're like, well, if you're not doing a full sale, then like, we're not going to waste time and resources on this. So I've been saying, hey, start those conversations if you think you need to, based on your burn, if you want to try and keep it going and raise, or as you said, consolidation, right? There's a lot of big players in your space. I'm sure someone would scoop this asset and, they can probably benefit from a lot of the synergies, cut expenses. They'll win your book of business. And, that's another, good outcome. So I do think consolidation, for the people who have the funding, the bigger companies, they will start to scoop a lot of these assets and just, take the book of business.
So another interesting thing with lower valuations and also the trend of having these unconverted safes and like debt products on people's weighing down people's cap tables. How are you seeing this impact them as they're going into like these upcoming raises or potential transactions?
Yeah, great question. I think we have had the benefit where a lot of the startups we work with have, really have large angels or kind of really supportive backers where, the money still hasn't been an issue. Raising at higher rounds hasn't been an issue, which is good. But I also think it's being strategic about who you're going out to. So I'm really trying to focus on, hey, I don't think an actual institutional is going to want this asset. Let's try and go to a bunch of different angels in the space. So I think that, that's part of it. The other conversations that we've had a lot is our last raise was during the zero interest rate environment. We got a frothy valuation. What are we doing on the business model side to run it to get to really justify that valuation? So, we're having conversations, for example, of we've been using, the founders, Amex to charge everything, right? Because we didn't have credit. Well, now let's use a platform like Ramp, build credit under us, because if we are profitable, if we do have cash flow, what if we can get a line of credit with somebody? Or what if we can do mezz debt and we can afford to pay that down, right? So it's trying to understand that like if we can get to a core cash flow arena that we may not have to raise. We could get a line of credit. We could get debt funding at a higher interest rate to help us kind of extend that next timeline to the round where we feel like we get to that valuation or a higher valuation.
And now turning a little bit more to your practice, how are you, managing like competing demands of like maintaining your practice versus the startup that you're working on versus like pipeline proposals, things like that?
Yeah, it's not always easy. I think it's, for me personally, I'm trying to, we have other fractional CFOs. And so when I'm bringing people in, I'm trying to engage our other CFOs early in the conversation so we can, tag team things and say, hey, like, Chris and I will be working on this together. Josh and I will be working on this together. So I can kind of be involved, but slowly pull myself out. For a lot of the legacy clients, like we talked about earlier, that I started with, it's not easy to really just pull myself out because I've been that face or that person for, a year. So for me, it's really trying to break out my schedule into, these days are kind of core internal team meetings on Mondays. And then Wednesdays and Fridays, I'm doing new client meetings or ad hoc current client meetings. And I'm leaving like Tuesday and Thursday to just work on my client base. So it's like, you really have to manage your schedule, because if you don't, you have a Calendly, people will just book. And very quickly, you're just doing biz dev for 8 hours or internal stuff for 8 hours. And then you don't really have time to actually work on the client stuff. So, for us, that's where the other important part is like building the house underneath of us. So we just brought on 2 new US-based accounting people, from big accounting firms, because like we just need more people, right, to scale that lower end to make sure that those things, can get done without me being involved of the day-to-day accounting, those types of things, so that I have more time to do biz dev or focus on the true finance side of these startup clients. But it's not easy, and it varies probably every week between internal, new business, current clients. It's a whirlwind, usually every week.
And one common theme that I'm hearing from speaking with other fractional executives is that it really isn't a zero-sum game. It's not like this hyper-competitive environment where you're competing for clients. It really is like these groups like yours play a pretty critical role in the ecosystem, especially for people who are just now starting to make that transition. What do those partners look like for you?
Yeah, some partners on like our own team, or
yes, those CFOs who are coming to work for or with you.
Yeah. So typically they have, a beginning base of a book. So like, we bring on somebody who has, 3 or 4 clients, startup clients, and they're at that phase where they're a one-man show, and they, they're doing all the accounting, they're doing all the finance, right? And they can't really scale their book unless they start hiring more people. Do they outsource the bookkeeping, right? Because they're trying to be lean and scale. Do they trust somebody, overseas to do it? So, we're typically finding these people who have a smaller book of business, but good access, and they just don't have kind of the resources to scale. And that's where we can say, hey, if you join our team, not only do you get access to other CFOs where, one of our CFOs brought on somebody who he's doing the accounting cleanup, helping them with their finance. He hasn't really done M&A. So now we're trying to help them build a pro forma and do those things, and he can access 2 people on the team who come from M&A backgrounds to help him. So it's like we're finding these people, and then we're either adding value based on our knowledge and sharing knowledge, or giving them access to software, giving them access to other accounting resources, an executive admin, people to manage their email inbox. We're kind of giving them that team to help them scale their business they couldn't do by themselves because they really hit a capacity.
And is there anything that you're reading, or any person you're watching, listening to, who's been really influential in terms of how you're choosing to run your business?
Yeah, that's a good question. I think for me, we're lucky that we work with a lot of really good operators in the startup space, and I talk to them frequently, and I really just see how they do things and how they're scaling, right? And so, when are you guys hiring? When are you doing X? And kind of the decision making and how they lead. So I do try to take like leadership from, we work with people who are, come from Zappos or have, real estate, and they all have all these different businesses, and I watch how they manage it. And then, there are other fractional CFOs on Twitter that, we have like a mastermind with, and then I chat with, and I just see how they're doing things, right? Like, I'll ask the question, you bring on somebody new who comes from your Twitter. How are you just kind of, giving it to another CFO under you? Or, hey, you have a one-man business. What was your first hire? So I'm either kind of trying to learn like leadership and scaling a startup from the startups we work with that I really, really enjoy how the founder leads or how he runs his business. Or I talk to other CFOs in the space, I'm texting one, last night, and giving them advice on things, and they're sharing their advice on things, and gives me new perspectives on how I should be scaling my business.
Thank you so much for coming on Fractionals in Focus. What's like the best way for people to get in touch with you?
Yeah, so I'm pretty active on Twitter. I'm not active on too many other social medias, but on Twitter, it's just my name. So it's Devin_J_O'Brien. So I'm pretty active on Twitter. You can DM me there. Or you can just email me at Devin, so DEVIN at Kordis, KORDIS.io. And yeah, you can I can share my Calendly link and and happy to chat with anybody. So those are typically the two best ways to reach me.
Well, it was really nice meeting you, Devin, and hope you have a great rest of your day.
Thank you. That's you as well.